Really looking forward to this one. It's for the advisory, and a record number of younger investors are apparently entering the market looking for value buys. So, how does income play into that? Alex Jamieson from AJ Financial Planning joins me now. Alex, a warm welcome to you. So, are we seeing a new cohort entering the market, particularly amidst all this volatility?
Yeah, certainly we saw a bit of gamification sort of taking place with COVID, with younger investors sort of getting involved. The technology's obviously been quite interesting for them as well too, the technology stocks, but certainly this idea about, receiving consistent cash flow is starting to be appealing, especially for people that are thinking about saving for deposits and those types of things and wanting some reliability around that investment and that approach.
So, when you are speaking with those that are newish to the market, how do you advise when it comes to seeking out that income? I mean, we were just talking bonds, but we can get it from shares as well.
Yeah, absolutely. Like if they're utilising what's called the first home saver scheme via super, indirectly, they do have some exposure to the equity market through the superannuation product itself. Certainly, you're wanting to have time horizons of around 5 years or plus. And then if they're wanting to create what we call micro saving accounts in their personal names, there's a lot of providers that are coming to market, and you can select higher income focused investment strategies, whether it be shares or fixed interest.
Now, we've got the question on the screen, franked or unfranked dividends. If you're, again, newish to investing, if you're still looking to build your wealth, how do you play that one, Alex?
Yeah, certainly a lot of Australian shares are fully franked, but if they have some overseas operations or if they're in infrastructure, we do see what we call an unfranked share. Somebody that is working though, and trying to, again, a young investor trying to save for that first home deposit, a franked dividend is quite attractive because it is tax paid, essentially meaning that if your marginal tax rate is at 30% or less, you wouldn't be asked to pay any more income tax on that dividend. The company's already paid it.
So, are there any pitfalls, I suppose, for looking or choosing stocks in particular because they're paying a higher dividend, whether that be franked or unfranked?
Yeah, certainly, typically we find often a higher paying dividend company is more mature in its life stage, and that often means the growth can be a little bit slower. That being said, what we've seen with the banks over the last 12 months, which typically have paid a high dividend, is probably counter to that idea. But certainly over the long term, we find by paying income, you do have that trade off around growth.
So, Alex, you'd be wise at any stage of your investment journey to really give some big thought and consideration as to how you're going to, form your portfolio with dividends in mind.
Yes, certainly that blended approach, having some allocation to pure growth is worth a consideration. And then if you are nervous around investing and nervous around, those first early steps into the equities market, selecting something that pays a higher income can provide some underpinning to your investment. And so, yeah, blending that in is a consideration point as well too.